Alright everyone, Cowboy Trades here, welcome back to the channel for another update on the stock market. So for the past couple of weeks the stock market has been rallying and a lot of people have been talking like this is the start of a new bull market and we've never seen a rally like this before or anything has changed. So in this video we're going to look at a few charts and give a quick reality check. We'll be checking out the SPY, SPX and the higher time frames, looking at liquidity conditions like book depth, cost to trade. We'll also look at oscillators, higher time frames, 2008 fractals, 2000 fractals, and also wrap up on some fear and greed metrics, which are currently sitting in greed and getting very close to pushing into extreme greed, which is not a good sign if you are a bull. So right off the back, let's start off with the SPX. Now, at this moment in time, the SPX is steadily approaching this macro downtrend. Now, this week we pushed up to 4,014, and this macro trend line is coming into fruition at 4,033. We've not exceeded this trend line before. We've only beautifully come up to it, tested it, got rejected, tested it, rejected, tested it, rejected. And we're very, very close to this at this moment in time. Now, if we come over to the SPY, you can see a slightly different situation. I mean, these charts are basically the same, SPY, SPX. It's basically potato, potato. However, the SPY is so close to touching the trend line. The SPY today pushed up to 400.22, and today this macro trend line will be coming in at 400.94, meaning, you know, we're literally millimeters away from touching this trend line. And we don't always have to touch the trend line exactly to get a nasty rejection. Of course, this could be the exact top and we could be getting ready to break back down to the downside. But nonetheless, if we do head back over to the SPX, you can basically see every time that we've come into contact with this, liquidity conditions have topped out and we've topped out on the trend line. If you're new, warm welcome. These blue vertical lines here correlate to the CME liquidity conditions. And over on the channel, we talk about what happens when the mid price, the book depth becomes overextended, meaning lots of money's flowing in the markets and the markets are extremely liquid, which in a bear market is normally a sign that that is a top. So as you can see here, blue line, blue line, blue line, blue line, these correlate to top in liquidity, top in liquidity, top in liquidity, and top in liquidity. Now, right now, we're pushing up extremely high. Now, if we come back over to December the 1st, where liquidity really started topping out, I'll put it just before December the 1st. I'll put it on November the 27th. So you can see this is where liquidity started to top out in the previous top round, round about here for the SPX, 4,100. And right now, liquidity, the mid price, the book depth is pushing up. In fact, we've actually got asks higher than the previous asks in this massive liquidity overextension that happened back on the 28th of November, which of course was at higher price targets, much higher price targets than we're currently sitting at this moment in time. So I don't believe we may be very, very close to topping out at this moment in time. So it looks like, I'll keep you up to date on this. I'm not ready to do this at this moment in time, but it looks like we could be adding a new blue vertical line indicating that liquidity conditions are topping out for the S&P 500. I'll keep you up to date on this. Like I said, liquidity conditions are topping out. If we come over to the month today, over on the 16th, you can see mid-price bids, asks, they are all just exploding to the upside. And because the markets are rushing to the upside, because liquidity is flowing into the markets, this means that it is becoming very, very costly to trade. So if we do head over to another liquidity tool and look at the cost of trade month to date from December the 16th, 2022, up until now, as of the time of recording, January the 16th, 2023, you can see the cost to trade, how much it costs traders to, you know, buy and trade the S&P 500 futures. It is absolutely through the roof right now. And normally, once again, this is very, very similar to the mid price. So if we do come back over, you'll see a very, very similar chart to the mid price and the book depth that we just looked at. You can once again see, you know, top in cost to trade, top in cross to trade, top in cross to trade. And in this area right now, cost to trade is once again pushing up very, very strongly, which is another sign that liquidity conditions are topping out. It's another sign that, once again, if you're longing right now, the cost of trade is extremely expensive. And of course, if you're shorting the market, you're going to be getting your funding fees paid by the bulls at this moment in time. So it's kind of a win-win situation. In the past hour or so, in the past 2 hours, really, you can see, you know, the S&P 500, the SPX, and the SPY have come up to this region and have started to have a nasty move back down to the downside. Now, if we come over to the oscillators, start off on the daily time frame, You can see the stochastic RSI is sitting at 100, getting ready to turn down. In fact, it has just crossed bearish in the past 24 hours. If we come over to the MFI, the money flow index is currently sitting at 74, indicative that liquidity is extremely overextended right now. You can also see we had a previous top here. So if we do start heading down from here, this could be a double top M pattern breaking us down to the downside. If we come over to the weekly time frame, you can actually see stochastic RSI is putting in a nice potential triple top. So the stochastic, as this moves up very, very quickly, and once again, this is the weekly time frame, so even if we start heading down very, very soon, it's likely that the stock starts to push up to this level before heading back down to the downside. So stochastic RSI, blue moving average, is pushing above the overbought level, currently sitting at 83. Orange moving average is sitting at 82, and the weekly MFI is pushing above the heart line right now, sitting at 62. It doesn't look like there's a downtrend in play, or what I mean to say is it doesn't look like there is a downtrending trend line to focus on at this moment in time, but nonetheless, weekly time frame, daily time frame, liquidity conditions are topping out and the market is becoming very, very overextended. So if we talk about the fractals, the 2008 and the 2000 fractal, before we move on to some fear and greed indexes, I would like to highlight, right now at this moment in time, we are getting a slight divergence from the 2008 fractal. Now, is this something to worry about? No, it's not exactly like, we've talked about this before, but every single bear market is different. You're not going to have bear markets track 100% every single time. That would be way too easy to trade. The markets are not that kind. So once again, when you're looking at the 2000 bear market, this is completely different than what the 2008 bear market looked like. And once again, the 2000 bear market hasn't beautifully tracked the price action at this moment in time, but nonetheless, you can still see, if we're just kind of drawing, a line of best fit through this, or, if I'm just drawing a trend line through this, you can see, once again, the trend is still your friend on this one. With the 2008 fractal, this has been beautifully tracking. But what I would like to highlight is, with the 2008 fractal, you are having a slight divergence right now. Is this, once again, like I said, something to worry about? No. You can see previous times, there have been a few divergences. Now, if you're looking at this at face value, you zoom out a little bit, you might be looking at this, obviously bear in mind we've retroactively fit the top. You might be looking and saying, hey, this called this rush, it called this low, this peak, this low, this peak, and it should be calling a breakdown to the downside now. But if you really zoom in, you can see there have been times like over here where, yes, the bottom was called, but we were predicting a top round about the 7th of March, and it took 1, 2, 3 weeks extra of divergence before we started to break down like it predicted. So you can see a 3-week divergence over here. Here you can see a bounce was predicted for, 1, 2 weeks, and we really didn't have that bounce. In fact, we continued to break lower, had another divergence for 2 weeks over here. Here you can see the lows were beautifully called and the top was beautifully called. The lows here were beautifully called, but then we had a top, and since then we were supposed to be breaking down. However, back here, the SP 500 in 2022, coming into 2023, you can see while this topped out round about, the 7th of November for, well, of course, this wasn't the exact 7th of November, but you get what I mean. The SP 500 2008 fractal was predicting we'd top out on the 7th of November, but we continued to push up for 1, 2, 3 weeks before we started to break back down to the downside like predicted. So, at this moment in time, it's been predicting since here that we break down, and we've been breaking down. Over here, it predicted a bounce over on this week before starting to break down. And as you can see, over here is where the divergence started. Over in 2008, we broke down into new lows. But here, this was the bottom when we actually started to push up. So this week started to diverge, and for 1, 2, 3, this is currently the 4th week, but we are starting to put in a tiny bit of red. So for approximately the past 3 to 4 weeks, the 2008 SP 500 fractal has been diverging. But once again, like we've said on this channel many, many times, this is not meant to predict the exact tops and exact bottoms, although it's done a great job of that in the higher time frames. This is really to show us that we are still on track with the bear market and nothing really has changed. Now, in the year 2000, the S&P 500 tech stock bubble is very, very interesting because you can actually see a lot of times where, where we topped out in the year 2000, the bottom was actually in, or should I say, the local top here and the local bottom here, because of course, in the higher time frames we went higher, and then in the lower time frames over here we went lower, but you get my gist. Once again, over here, you can see, once again, this is kind of like the inverse of this. This was predicting a run to the upside, and right now, in my opinion, I think we could be starting to top out. So sometimes these are a little bit inversely correlated, but nonetheless, the macro trajectory of the 2000 fractal is still in play. And, once again, the peaks and troughs that I do believe we're moving very, very similarly to the 2008 financial crisis. And of course, we've just replaced, if you've watched The Big Short, you've done economics before, you know what caused the 2008 crisis. It was the subprime mortgage crisis. We've basically just replaced subprime mortgages with extreme leverage in the markets. Don't believe me? Find out how much leverage is in the cryptocurrency markets. Go ahead, find out how much leverage is in crypto. Go find out how much leverage is in the stock market. Try and find out. You cannot find out. So this is the whole point. We don't know how much leverage is in these markets. We do know that there's tons of derivatives, there's tons of futures, there's tons of contracts, which are slightly harder to track. There is so much leverage in these markets, and I do believe, this leverage is going to cause the next boom and bust cycle. And of course, once again, while this is predicting a breakdown now, I think this could take another week or so, but I do believe that general ebbs and flows, we are going to follow the trajectory of this trend. Once again, if I'm drawing a trend line through this, a line of best fit, the SP 500 of 2008 is predicting something like this. And if we get rid of the chart, this is more or less the line of best fit for what is happening at this moment in time. So, once again, all bear markets are different. We are seeing a slight divergence over here, but I do think we're going to start breaking back down soon. Now, if we wrap up the video on some fear and greed indexes, when I was looking at the S&P 500, or more specifically the stock market fear and greed index earlier, this actually came in at 68, and I did post this over on Twitter. The Bitcoin fear and greed index is currently pushed into 51, so cryptocurrency markets are neutral, stock market is in greed territory. Earlier when I posted this was at 63. About an hour or so ago, I believe I reported on this in one of my cryptocurrency videos when it pushed up to 68 a little bit earlier, and it's come down to 66 because, once again, if we do come over to the hourly time frame, in the past couple of hours we have started to come down, and this is very reactive, unlike the crypto fear and greed index, which gets updated maybe once a day, once every 12 hours or so. So this does update in live time. Right now we're sitting at 66 in greed, and we're only 9 points away from ticking into extreme greed. If we look at the market momentum, this is currently sitting at neutral. Stock price strength is pushing into extreme greed. I'm not going to explain how all these are calculated. If you want to learn how they're calculated, feel free to pause the video and read the little description to the right over here. If we come over to the stock price breadth, you can see this is in extreme greed. Put and call options, very, very important. I definitely recommend reading about this one. This is in greed. Market volatility, this is in neutral. Now, this one is very interesting. I'll explain a little bit about this one. The market volatility is calculated using the VIX and the 50-day moving average. Now, if you do watch my channel, you know that I do cover the VIX quite frequently, and right now the VIX is in a meltdown. I mean, the VIX has, pushed back down. I mean, we're still making higher lows and higher highs in the macro time frame. However, the VIX is pushing down right now, and of course its 50-day moving average will also be moving to the downside right now. So when we do look at market volatility, we are in neutral. However, a lot of the time when we come down to this neutral territory, the VIX gets ready to start blasting back up as the 50-day moving average starts to move back up with it as well. So, right now, market volatility is at neutral, and, once again, it was at neutral over here before a massive melt up in the VIX. It was neutral here before a massive melt up in the VIX. It was neutral here before a massive melt up in the VIX. So, being at neutral just means at this moment in time, it is a slight signal of fear, indecision, and neutrality in the market. However, previous times when this has been neutral, it has called for a big move up in the markets. And as we know, the VIX is inversely correlated to the S&P 500. If we overlay the S&P 500, a move like this up in the VIX correlates to a move to the downside in the S&P 500 and Bitcoin. So there we go. Once again, if you want to read more about this more precisely, then read this little description over here. Safe haven demand is in extreme greed, and of course the markets are still a little bit undecided whether we're fully bullish. I see a lot of people right now, of course we're sitting in greed right now for the fear and greed, and a lot of these indexes are in greed. But a lot of the time, people buying junk bonds, these are much higher risk. So normally, once people start buying junk bonds, this is typically a sign that you're moving into more bullish territory where there's more liquidity in the markets. But right now, nonetheless, this is in fear at this moment in time. So, you know, when we summarize all of these, we've got one in fear, one in neutral, extreme greed, extreme greed, neutral, and also coming into greed over here, potentially getting ready to push into extreme greed. Now, there's no guarantee we'll push into extreme greed because, of course, when you are looking at the SPX right now, like we talked about, we are running into resistance right now, and it's looking like liquidity's topping out, cost to trade is topping out, SP 500, the SPY and SPX to be specific, is approaching this very, very important trend line. Oscillators that we talked about over here are extremely overextended. So I just wanted to give you a quick reality check. Once again, a lot of people are acting like we've never seen a rally like this before. However, we've seen many rallies like this before. We saw a rally over here, 1, 2, 3, 4, 5, 6. This is, you know, the 7th macro rally that we've seen, and it seems like people never learn their lesson. People were bullish here and here and here and here and here and here and also here. So once again, be extremely cautious. Nothing has changed. Macro downtrends are still in place, and in my opinion, the bear market has lower to go to the downside. That's all I've got for you for this video. As always, my friends, if you do enjoy the content, let me know down below by leaving a like and a comment. Share the videos with your friends, and if you do want more of my posts, charts, memes, economic data, be sure to follow me over on Twitter at 618_cowboy, and come and join the Discord. If you head over to my YouTube and click on About, you can see my official links are down below: Twitter, Discord, Instagram, and official merch. Hope to see you on the Discord. Hope to see you over on Twitter. For today, that's all I've got. It's been your boy Cowboy Trades. I'm out. Peace.